It has been said that learning to invest is like learning a new language. For many, the confusion is because of the unfamiliar investing terms they encounter. As a new investor, you may be overwhelmed initially, but as you become familiar with them, the intimidation factor will diminish. To help you along, here are some common investing terms you should understand. Stocks. A stock is an investment that represents a share or ownership in a company. For example, if you own a share of Amazon, you own a small piece of the pie that is Amazon. As the company grows and increases in value, the value of your share or stock increases with it. This is often referred to as a common stock. There is also what is called a preferred stock, which is a class of ownership and additional rights. Stock market. You have certainly heard about the stock market. This refers to the collection of markets and exchanges where the buying, selling, and issuance of shares occur. The financial transactions we describe are carried out through formalized, institutionalized exchanges. The New York Stock Exchange and the NASDAQ are the most important exchanges in the United States. Bonds. A bond is essentially the same as a loan. When you purchase a bond, you are often agreeing to lend money to a government or a corporation. In most cases, the bond issuer agrees to repay the entire principal loan amount at a later date, known as the maturity date, while also paying interest income based on a coupon rate in the interim. There are numerous types of bonds. These include government-issued bonds like treasury bonds and tax-free municipal bonds. Government operation and capital projects are frequently funded with these bonds. Corporate bonds are a type of bond that allow businesses to fund their operation and invest in their growth. Risk versus reward. All investment involves risk, and the underlying concept is that if you are willing to take on more risk, you should be rewarded more. Investing in low-risk assets reduces the likelihood of losing all or part of your investment, but it also reduces the likelihood of receiving substantial returns. Similarly, if you are willing to invest in assets with significant volatility and bigger risks of large losses, you should expect more potential growth. Generally, stocks are higher risk investment while bonds are lower risk investments. Consequently, the potential returns in stocks are higher than returns from bonds. Investment funds. Think of an investment fund as a pool to which many investors contribute, and that is used to buy stocks and bonds collectively. This represents a good way to diversify your investment. When you diversify your investment, essentially, you are spreading the investment around to limit exposure to any one type of asset class in order to maximize your return. Think of diversification like not having all of your eggs in one basket. If 100% of your investment dollars are in a single stock, say Microsoft, and the stock takes a tumble in value, well, there goes all of your money. Investment funds are therefore a good way to limit your exposure and risk to any one stock or asset class. There are different types of funds, so let's talk about a few of them. Mutual funds. A mutual fund is a pooled portfolio of investment. Investors buy shares or units in a fund. A professional portfolio manager is charged with allocating the assets of the fund and attempting to generate capital gains or income for the fund shareholders. Index fund. An index fund is a mutual fund with a portfolio designed to match or track the components of a financial market index, like the S&P 500 index, for example. Like mutual funds, they give the investor broad market exposure, but unlike regular mutual funds, index funds are passively managed, have minimal operating expenses, and low portfolio turnover. Regardless of market condition, an index fund will always track its benchmark index. Exchange Traded Fund, or ETF. ETFs are similar to mutual funds, but they are not the same thing. They trade like stocks on stock exchanges throughout the day and have their own ticket symbols like regular stocks. They generally have lower investment minimums when you start investing than regular mutual funds and are generally less risky than individual stocks, as they are a collection of pre-selected stocks and bonds. This conversation about mutual funds is not complete without mentioning again the annual operating expenses, which are ongoing fees that cover the cost of managers, accounting services, legal fees, and so on. Even small fee discrepancies between funds might result in significant disparities in your investment returns over time. Dollar cost averaging. Dollar cost averaging is merely a fancy word for the practice of depositing little amounts of money into a retirement account on a regular basis, such as every pay period or once a month. Ignore the price changes in your investment. You are investing the same amount of money whether it goes up or down. The effect is that you lower the average cost per share over time. Compound interest. Compound interest allows you to earn exponentially more on your investment. You reinvest your interest and earn interest on top of interest. Let's illustrate this with an example. Imagine you invested $500 and it earned 10% interest. That's $50. Your interest is added to your $500 principal, and now you have $550. At the end of the next year, if you earn the same 10% interest, you now have earned 10% on top of the $550. Now you have earned $105. You earn interest on top of the interest you have already earned. That is the power of compound interest. So now that we have gotten some of the basic investment terms out of the way, let's turn our attention to the actual investments to have in your portfolio. Our intention here is not to tell you what securities to own, but to give you some guidance based on your investment philosophy, risk tolerance, and goals. Decide if you want to invest on your own or if you want assistance. You have three alternatives when it comes to investing. Do it yourself, employ a robo-advisor, or pay a financial professional. If you're only investing a modest sum of money, this is certainly an easy decision. If you do not have much money to invest, you should not and probably would not be able to hire an investment advisor. Robo-advisors are AIs that manage your investment typically for a small cost based on information you provide. If you are investing in a 401k or other IRA, you will have access to mutual and index funds that makes it easy. You have reputable companies and apps to choose from. Today, there are numerous investment firms that provide free trade and account minimums that are incredibly low. Companies like TD Ameritrade, E-Trade, Fidelity, Schwab, Robinhood, and Webull all offer commission-free trades and account minimums of less than $10. With your company's 401k plan, you will not need to choose a company as they will have a pre-selected firm. What investment to choose? Rather than betting on the performance of a single company, bet on the future of free market capitalism. It is advisable to invest in a diversified fund like an index fund or a target date fund over individual company stocks. Target date fund. With a target date fund, you pick the year closest to your planned retirement and put your investment money into it. These funds are available in 401k plans and IRAs. Index funds. Index funds are available in IRAs and your employer sponsored plans like a 401k. Be aware that many of them have minimum investment requirements, typically between $1,000 to $3,000, and virtually all of them will charge you a small annual fee. Dealing with wild market swings. The markets always fluctuate up and down, up and down. This is often referred to as volatility. The best response is to stay the course. Investing is a long-term strategy. If you have a diversified portfolio and a long-time horizon, it is best that you keep putting money in month after month, period after period, and forget about it. You will be glad you did. Thank you for watching. Please like, comment, and subscribe to our channel. We will see you next time.